Hello and welcome back to Patrick Boyle on Finance. So today's video is all about Robinhood, the trading app which is facing a civil fraud investigation from the Securities and Exchange Commission. Millennial trading app Robinhood is facing a civil fraud investigation from the Securities and Exchange Commission for failing to disclose that it was selling clients' orders to high-speed trading firms, according to the Wall Street Journal. The investigation revolves around Robinhood's practice of being paid to route customers' orders to high-frequency trading firms like Citadel and 2 Sigma. Robinhood's entire business has been built since its inception on selling its customers' orders, which is known in the business as payment for order flow, to high-frequency trading firms. These payments account for 70% of Robinhood's $130 million in revenue during the first quarter. In the second quarter of this year, Robinhood's payment for order flow revenue doubled to $180 million. At competing discount brokerages like Schwab and E-Trade, payment for order flow only accounts for around 3% and 17% of revenue respectively. Robinhood has been growing a lot during the COVID lockdown, adding 3 million new accounts in the first 4 months of 2020. The press has reported that many sports bettors who have no games to bet on right now have taken to trading stocks. Payment for order flow is a controversial practice that's been referred to as a kickback by some. It was pioneered by Bernie Madoff. Yes, that Bernie Madoff. He described it as a way for market makers to outsource the task of finding orders to fulfill, and he compared it to retail arrangements in which a supplier pays for the rack on which its products are displayed at a store. Although the practice was uninvolved in Madoff's later fraud scheme, it has long been controversial. The SEC does permit this practice because they feel that it sustained competitors to the New York Stock Exchange and reduces the likelihood that the New York Stock Exchange specialists would have monopoly power. The UK's financial authority banned the practice in 2012, and according to Barron's, trades executed at the best quoted prices jumped from 65% to more than 90% between 2010 and 2014. High-frequency traders are not charities. The only reason that a high-frequency trading firm would pay Robinhood between tens to hundreds of millions of dollars for order flow is that they feel they can exploit the retail customers for far more than they pay Robinhood. It's worth noting that under SEC rules, traders are not obliged to get the best price for clients. They're obliged to get the best execution, which can include other factors like the speed of the trade. According to the Wall Street Journal, the investigation is at an advanced stage and the company could have to pay a fine of over $10 million if it agrees to settle. A deal apparently is unlikely to be announced this month, and the two sides have not formally negotiated a proposed fine. A Robinhood spokeswoman declined to comment on the investigation or any talks with regulators to the Wall Street Journal, but said that Robinhood strives to maintain constructive relationships with our regulators and cooperates fully with them. So is this a terrible thing? Should you avoid trading apps like Robinhood? Well, in my opinion, there's nothing too shocking going on here. Most new economy firms have a business model where they offer you something that appears to be for free, but this is just because they have a different way of monetizing whatever it is that you're doing. Social networks like Twitter and Facebook are free, but then they make money by selling user data to advertisers. What Robinhood is in trouble for is a disclosure, which based on the news it would appear that they have since remedied. Overall, it's kind of cheaper to trade stocks today than it was at any point in history. In the first day trading boom of the late 1990s, when discount brokers first appeared, they were selling order flow to Bernie Madoff, and charging commissions of between $12 and $15 per trade. Today, they're getting paid far less for selling the order flow, and that's largely because of decimalization. Basically, the market makers are less profitable, or the high-frequency trading firms that are stepping in are not making as much money as the market makers were in the 1990s, and thus they're paying less. And they are not charging a commission. In the 1980s, retail trading commissions were as high as 5%. Robinhood is not a bad company that's ripping off their customers. They're a new economy company that has found a different way to generate revenue. There are issues with what high-frequency traders do with the order flow, but these are also being cleaned up by the regulators, and actually it's a lot better today than it was 5 years ago. It's not obvious to me that any of these abuses by high-frequency traders or by brokers are any worse than what floor traders and specialists used to do when I started out trading in the market. If you want to learn more about high-frequency trading, I'll put a couple of book recommendations in the description of the video below. I guess the real takeaway from this video is just that nothing is for free, and you shouldn't be too surprised or too offended by this. Robinhood is a company that's in business in order to make a profit, and they're making a profit by selling this order flow to high-frequency traders who possibly profit from it. So you're not getting to trade for free, and you should take that into account when you are trading. A lot of people think that because they're not paying a commission, they're trading for free and can trade as much as they want to. That's not the case, and I explained that, I think, 2 videos ago when I talked about bid-offer spreads or bid-ask spreads and how traders end up, running up transaction costs just because of that. I'll leave you now with a clip of former SEC Chairman Harvey Pitt giving his thoughts to CNBC on Robinhood and payment for order flow. Don't forget to like and subscribe. See you later.
There isn't necessarily any detriment to investors by having the sale of order flow. The investors may still be getting a better price than they otherwise would be able to get. But what you do have is the potential for conflicts. And it's important for investors to know what's going to happen with their information and their orders. Part of the difficulty with Robinhood is we're dealing with a whole generation of millennials who are not used to trading in the markets, and therefore they may not understand what the consequences are of using what appears to be a completely costless execution service.
Stuart, can I see you in my office, please?
That kid is sick. Hinge is squeaky. Very sick.
Stuart, get in here.
Sure thing, Mr. P.
Stuart, I just opened my Ameritrade account.
Let's light this candle.
Let's go to Ameritrade.com. It's easier than falling in love. What do you feel like buying today, Mr. P?
Kmart.
So research it. All this stuff is provided for you free of charge.
No cost.
Yeah, that's synonymous with free.
Looks like a good stock.
Let's buy.
Let's buy 100 shares.
All right, click it in there.
Okay.
How about 500?
100, Stuart.
You feel the excitement? You're about to buy a stock
Okay.
online.
Oh! Fabulous. I'm thrilled. What did that cost me?
$8, my man.
Mike Broker charges me $200 for this.
Riding the wave of the future, my man. I gotta get a soda.
All right.
I'm sorry, Mr.
Wait a
P. I'm
minute.
having a party on Saturday night if you really want to go.
I'm going to try and get there. Thank
Happy
you, Stuart.
trading.
Thank you.
Rock on.
All right, Stuart.